Welcome to the daily update, where I'll go over the action in the market for Tuesday, December 19th, and then we'll see how things look for Wednesday, December 20th. Pretty much a carbon copy of Monday's session happened again in Tuesday's session. We had a higher open, we got up to R2, we pretty much stayed in that area. There's a real lack of selling, at least at this point. But this time did see a real improvement with the small caps. So maybe the January effect is starting to kick back into gear. We're still well overextended to the upside. We've been overextended for a number of weeks. Now we're even more so, and we're getting some longer term indicators that are starting to flash some signals to us that at some point we're just due for some kind of a pullback. Let's go back and talk about what happened. Right at the open, we did have a higher open. Prices climbed above R1. And again, because there wasn't a lot of movement in Monday's session, that made the pivot points pretty close to each other in Tuesday's session. But R1 was at 47.52. We got up to R2 at 47.62. As the day went on, we drifted a little bit above, a little bit below R2, and we closed at the high for the session. We were up 0.59% on below average volume. That's one thing that we're starting to see now as we get closer to Christmas, is we're seeing a real shift over into holiday mode. Our technicals, we're still positive. When you look at all the charts, everything is just looking pretty good right now. There are a couple of warning signs, specifically the transports and growth. Those areas are lagging. But when you look at the price charts, we're looking good, but almost a little bit too good for right now. It's about inflation, interest rates, and this gradual shift from the Fed being more hawkish to gravitating possibly over to being more dovish. Some comments that we can make: there's a real lack of selling conviction and the fear of missing out, or FOMO. You've got folks that want to lock in some gains. They want to get into the market because they're afraid they're being left behind here. And a lot of times that is when the party is pretty late in happening. And so we'll have to see, is that going to lead to something either between now and the end of the year, or sometimes right after the beginning of the year, everybody comes back after the holidays, and sometimes we can see a real downward move to start off the year. I don't know if that's what will happen or not, but the market is sure setting itself up for some kind of a pullback the longer we stay in this extreme positive territory. And small caps did have a good day. I have some additional charts to show you there. The Dow and the NASDAQ 100, because they had up days, ended up setting new all-time highs. The S&P is getting close, but it's not quite there yet. The Bank of Japan ended up leaving their policy rates unchanged. They met and decided not to do anything for right now. So here is our list, and it's pretty long for the short term. It's even longer for the intermediate term, but we have our ADX indicator, which is well above 40, and the green line's also above 40. A new one is the advanced decline ratio based on 19 periods. I have two different studies to show you that. The 20-period exponential moving average, the Stochh RSI, Williams percent R, CCI 14 and 20, our stochastics chart, the PMO oscillator, the RSI based on 9 periods, and the boom indicator based on 20 periods. Really, other than adding the advanced decline ratio, this is the same list as from yesterday's video. We're getting even a little bit longer now with our intermediate term. We have our intermediate term ADX indicator well above 40, as is the green line. The 50-period exponential moving average study, we're still really high with the standard deviations chart, the Arun, the PMO studies, the Chaikin money flow, as well as the Sean trend meter, and the Chaikin oscillator, the balance of power, the CMB composite, the bullish percent index for the S&P and the NASDAQ, the RSI based on 14 periods, the percent B, the boom indicator based on 50 periods, the ultimate oscillator, our new high, new low study for the S&P based on 10 periods. A new one is the 19-day advanced decline ratio, where the first chart that I use, that goes into the short-term category, but then the longer study that I do near the end of the video, I put that more in the intermediate term, as well as some 50-period moving average studies when we look at the mid caps and the small caps, and I'll have some charts to show you. Long term, We're seeing a couple of different of our longer term moving averages looking extreme. The 200 period, both exponential and simple moving averages are getting extreme, as well as the 150 period moving average. We're still dealing with this same scenario that the Fed could possibly be done raising rates, and the market is trying to anticipate that they're going to be cutting rates as soon as possible. At least they're pricing this in to happening in March. Now, this is going to change a lot. And as we get more economic reports, that'll all shift around and the market will finally either get it wrong and then have to react to that, or the Fed will end up doing what the market thinks it's going to do. The dollar was down and interest rates were down, and that helped give some support to stocks. We're at 3.92% for the 10-year yield, well under that 4.02% level, which seems to be rather critical. We still have the 10 to the 2 and the 10 to the 3-month yield curves that remain inverted. Sentiment is, we're really getting high now. This is starting to get pretty extreme. We have an extreme positive reading at 80, where we ticked up from 77. But we're still positive when we look at our trend. However, we're very overextended with both the short and intermediate term ADX charts. Our bias is positive. That's just because we had the update, and our momentum the last number of days continues to be positive. We did have a little bit of Fed speak that came out. Fed President Bostic from Atlanta, who will be a voter in 2024, I guess isn't really paying attention to the news or something, said that he does not see an urgency to cut rates in 2024. Maybe this is trying to front run the market a little bit and not to have them get too exuberant right now as the Fed is shifting over. But the market didn't really pay attention to that all that much. Some reports that came out, we had building permits that came in at 1.46 million, just as expected. And last time it came in at 1.498 million, a little bit down from the last reading. But what was rather encouraging are the housing starts, and that was at 1.56 million, well above the 1.36 million they had expected, and up from the 1.359 million that we had last time. So here's a chart showing the 3-month average of housing starts and building permits, and we're going down on the average overall, but we did see a real pickup in the latest reading. The starts are starting to show some improvement, and this could suggest some improvement in the economy. Housing tends to do better in a falling or lower interest rate environment, and if that's what we're starting to enter, that could really help the whole real estate sector. And here's the annual look here showing how the housing starts have been going up. Then looking at our intraday chart, it's pretty much the same as what we saw on Monday. We had a higher open, we got above R1 and went up to R2. That acted as overhead resistance, and we stayed a little bit above, a little bit below that for the rest of the day, and then we ended up seeing some kind of a buy program come in later on. This might be some shorts thinking that, yeah, we're going to go down, and this is a market on close type of thing, and so that you have to buy to get out, and that might have pushed prices up just a little bit higher. Here's our intraday chart where we were positive in the pre-market session, and then we saw a move higher, and we're a little bit higher in the initial overnight session. And we're seeing growth now starting to lag a little bit behind value. We had seen the blue line above the red line after Monday. Now we're seeing the red line going back above the blue line, and that's a little bit of a concern. We actually came down with our S&P 500 growth to value ratio. That ended up being down on the day. We thought we were seeing some improvement, and for a couple of days we were, but now we're starting to see that fall back. Some end of day charts where both growth and value were up for the large caps, but growth really underperformed. It also underperformed for the mid caps, but really outperformed for the small caps. And we're ticking back down with our end of day growth to value ratio for the S&P. We're down here at the lower end of this range that we've been in. It would be nice to see this going up, but we're just not seeing that, and that is a warning sign. We did see a real improvement again with discretionary to staples, where we're looking at the bottom with the ratio where it did tick back up, showing that discretionary is outperforming. And that's another form of growth versus value. Keeping an eye on our trend, our ADX just keeps going up and up and up above its moving average. The green line is on top and is also above 40. This is the intermediate term, and we're seeing that same thing with the short term chart here with the ADX just going higher and higher. Volume is dropping off just a little bit. We were a little bit below average in Tuesday's session. We're wondering if we're still at the latter part of December now, where we continue to see the VIX fall, and that's kind of what we're seeing happen to a degree. The problem is that the VIX is so low that it doesn't really have much more to go, really. But looking at this fear gauge, the Ulcer Index still suggests there's not a lot of fear. We ticked a little bit sideways with the line chart, and we're coming down to this blue line. That would be a really extreme reading here with the line chart, and we ticked up just a little bit when you take the overall bar for the day. And we're seeing volatility of the VIX picking up a little bit. This might be folks getting ready to head out and enjoy their Christmas, or maybe they're taking next week off and they want to do some hedging ahead of that. And the skew index, it's no longer extreme. We spiked up and now we're starting to come down. At least to this point, it looks like we're seeing a continuation of the uptrend, but that could always change at any time. The equity put call ratio also ticked up just a little bit. Again, this could be some hedging ahead of the holiday as folks get ready to be gone. And we're seeing our 5-period turning back up just slightly. I don't know if that's necessarily negative because of the time of year that we're in, but eventually we want to see this continue to go down for that to be more positive for the S&P. This is showing some improvement here. The risk on to risk off ratio continues to show an advance. We're coming close to this previous high here. If that could continue to go up, that would be positive. If it starts to go back down, that would be more negative. We are looking good with our advanced decline line based on price and volume. We're breaking out here on this previous high where we haven't broken out yet based on volume. And with the decrease in volume, we're still seeing new highs doing quite well, but we're going sideways with our 5-period. We did tick up just a little bit with our 10-period. And we're getting extreme with the advanced decline ratio based on 19 periods. That's the blue line, where the red line still continues to be positive. The accumulation distribution is still quite positive and maybe a little too positive. We're getting kind of far away from this moving average. The Chaikin money flow also looking pretty extreme, although it is still positive. And we did see an improvement with the cumulative NYSE advanced decline line as well as the regular advanced decline line. We haven't come quite back up to this previous top yet. And our other advanced decline line also not quite back up to this previous top. It's showing some improvement. If we stay above these moving averages for a few more days, we might end up seeing a golden cross with the advanced decline line ratio, or just the advanced decline line. We did see a little bit of a tick up with our common stock for the NYSE. That's breaking out above this previous breakout point. We did show some improvement based on volume, but it lagged a little bit. The advanced decline line studies were going up with the NYSE common stock, the S&P, the mid caps, and the small caps. So we saw pretty much across the board upward movement in Tuesday's session. Here's our daily chart, still looking pretty good. We have green bars here. You could point out some previous highs or these other pivot levels as potential overhead resistance, but right now the market just keeps floating higher, where we look down at the bottom where we're below average with volume. And we're getting extreme with the 20, 50, and just barely extreme now with the 200-period exponential moving average study. The boom indicator based on 20 and 50 periods is still extreme. That means we're getting far away from those moving averages. We're still showing some improvement with our 200-period moving average study. And then we have our usual suspects. The Stochh RSI is extreme positive, the Williams percent R, the CCI 14, and the CCI 20. The force index is still looking positive. It's going up, and the midpoint continues to go higher. And our stochastics are extreme in the short, intermediate, and long term. We're still extreme with our standard deviations chart. We're still well above this +3 standard deviation. We're even outside of that. I could put a +4 in here, but we don't see that very often. So this is kind of a unique situation. The balance of power continues to go higher, and that's extreme positive, but the go, no-go system still suggests that the trend is positive. We're still up at the blue line with our highest high value, and the midpoint continues to go up. The TTM squeeze is coming back up with a darker, actually it's a lighter shade of blue. That's positive. The CMB composite is extreme. we're kind of flattening out, but still having a slight upward bias with the ease of movement indicator. And we're still extreme with the Arun indicator, showing that the buyers are in complete control. The sellers are all the way at the bottom. That's the red line. That's why we're getting this extreme reading. We're continuing to go up with the summation index based on price, and we've turned back up based on volume. We've seen a couple of times here that might have been flashing warning signs that ended up not necessarily panning out. We're going up with the summation index with the NYSE based on price and volume. We're not quite back to these previous highs yet. We're turning up slightly with the Swenlin trading oscillator, both based on price and volume. And we're getting very extreme with the PMO. When we look at the indicator by itself, we're also extreme based on price, and we're not quite extreme based on volume. It's rolling over a bit, but it is still positive. We're no longer extreme with the PMOs that are rising. We're right on the line with the buy signals, and we still are extreme positive with the PMOs above zero. The Swenlin trading, what am I saying? The Elder's Impulse system continues to be positive for the S&P 500. We're still positive with the parabolic SAR. The slope oscillator continues to go up and is extreme positive. The MACD also is positive, but extreme. So all of our oscillators are pretty much positive now, and they're all giving us pretty extreme positive readings. Looking at the moving averages in our moving average tree, we're still well above these, all the okay, let me try that again. We're still above all of the plotted moving averages in our moving average tree, and as we continue to go up, these lines are smoothing out. And we're still extreme with the bullish percent index for the S&P. We're still positive with the bullish percent index for the NYSE, and we're very extreme with the NASDAQ 100 bullish percent index. We're getting back to really extreme with the Sean trend meter. We're extreme with the Chaikin oscillator. The money flow is turning back up and is still positive. The ultimate oscillator is very extreme. The vortex is just positive with the green line going up. And we've spent 4 trading days now above the upper Bollinger Band. That is very, very rare. We're still getting an extreme positive reading. The Copic curve has crossed over and is now looking more positive. The RSI based on 14 and 9 periods is also extreme. On balance volume is still positive, and we're getting up to this 90% level with the 200-day moving average study as well as the 50-period moving average study. That's looking pretty extreme. I don't have any Fibonacci or line studies now because we're breaking out above all of them, at least to this point. So we look at the trends based on our different charts where the Heiken Ashi remains positive, the Kegi is positive, the Renko is positive, and the 3-line break continues to be positive. And we have a new X that came into the point and figure chart. We're still working off of a signal that was generated on November 20th, which was a double top breakout. And so far that is continuing. Some long-term charts. Here's our 150 and 200 period moving averages showing that they're pretty extreme. And we're above this trend line when we go back to the 1987 crash. Can we stay above that if we end up seeing some kind of a pullback? The NASDAQ 100 is also trying to break above this trend line going back to 2009. This could end up acting as overhead resistance. Looking at our other indexes, the equal weight is showing some improvement and performing a lot better when compared to the S&P 500. We're pretty much sideways now. We ticked up, we ticked down just a little bit with the ratios because the broader market did better than the mid caps. And we're looking good with the Dow. We're breaking out above this previous high, but we have not come back up with the transports yet. Right now, that's a negative divergence. We'll have to see if the transports can improve and at some point break out above this high and then end up confirming the Dow breakout. And utilities were up just a little bit. Where transports continue to underperform the Dow. The Dow is still looking pretty strong. The diamonds have switched from being neutral back over to positive. The NASDAQ is also just trudging higher above this R1 level. The NASDAQ 100 is also looking pretty healthy from a bar chart stance and still looking really actually quite positive. The Qs are remaining at positive for the Elder Impulse system. And the NASDAQ 100, based on the momentum, it's continuing to be positive. And we're setting new all-time highs when we look at the weekly chart of the QQQs, which is the NASDAQ 100. Small caps were finally breaking out after having 3 sessions at this one area, we did see some real improvement. They were up over 2%. We are still working off of a longer-term downtrend, but we might be getting ready to cross here fairly soon. We did break out above this resistance when we look at the Russell 2000 index, but we're really extreme with the RSI. On a momentum basis, we continue to be positive, and we're positive with the Elders Impulse system for the small caps. The mid caps didn't have quite as strong of a day, but are breaking out of this recent range, and they're back to positive for the Elders Impulse system. And we were up again with the financial sector. It's showing a lot more improvement and in an uptrend. The micro caps were also up over 2%. We're up into the 114 range now. And the FANG index was up another 0.5%, setting another new all-time high. And we also see that here on this other chart. The dollar index, it shows it being up here, but it was down in the session. This up is just kind of a bit of a bounce from the close. And that's one thing to keep an eye on. If we start seeing the dollar really bouncing back up, that could bring some weakness into stocks. Looking at yields, not a lot of change here. We were down a little bit with the 10-year yield. We were up a little bit based on price, but we're chopping sideways right now. We're still getting a positive result when we take the 1-month yield and subtract the 3-month yield. And then a couple of additional charts here just to show you the growth of value. We're looking a lot better with the Qs to the S&P as well as discretionary to the S&P. Not showing a real big improvement yet with large cap growth versus large cap value. So the large caps, not all that strong, but the mid caps are showing some improvement, and we're getting back up to the moving average with the small caps. We're still, and we've spent a couple of weeks now, really extreme positive with the 10-day average of the S&P 500 highs minus the lows. We're still looking good when we look at the broad market. When we measure the highs minus the lows, we're above zero. And our longer-term study for the S&P of new highs minus the new lows, that continues to go up. We are, for the most part, continuing to drop with the 2-year yield, which has been giving support to the S&P. And these are some new ones. This is the S&P with the 50-period moving average study. We're getting up above where 90% or more of the stocks in the S&P are above their 50-day moving average. That's usually an overbought indication. And we're seeing that same thing with the mid caps now and the same thing with the small caps. So that's one thing that we want to be aware of. And we're also getting extreme with our other study of the 19-day exponential moving average of the S&P advanced decline line. We're getting extreme based on price and barely extreme based on volume. So what's our outlook for Wednesday? We are in holiday mode as volume is dropping off. There will be some more economic reports that come out. And if the market really reacts to that, that might pick up the volume. We're dealing with earnings as they are released. We are still positive, but well overbought, and continue to be so. We will get the MBA mortgage applications index, consumer confidence, and existing home sales in Wednesday's session. And then we're keeping an eye on all the different geopolitical events that may have an impact. Here's the economic calendar. We're going to get the third estimate for GDP on Thursday, as well as the LEI, the leading economic index. The big one is going to be on Friday with the PCE prices. Looking at seasonality, we are neutral to negative across the board for December 20th. We were quite negative for Tuesday's session, but we ended up having an up day. That's why we just use seasonality as a guide, not necessarily to make decisions. We are in the week after options expiration, where we're up 64%, down 35%. And then looking at our different seasonal charts, it looks like for right now anyway, the January effect is happening, where the small caps are outperforming the large caps. We see a little bit of an improvement during a pre-election year. We will be on the 14th trading day of the month. And then Carson actually has us going down a little bit on this day, but they're measuring from 1950 to 2022, no matter whether it's an election year or not. And we will be in Wednesday's session, which tends to be the most negative day of the week in 2023. We are looking positive when we look at our various seasonality charts for the S&P. Also, this seasonal chart, as well as the other seasonal chart, and this seasonal chart, and the Carson seasonal chart, and even the equity clock seasonal chart. All of these are looking positive. When the NASDAQ is also looking positive seasonally, as well as the S&P 500. And then we're wondering if we're going to mirror what happened back in 1982. So far, it looks like we could be going along that same basic path. We'll just have to see how the beginning of the year really makes things either go up or down. So our scenarios, we're not going with the down one yet. Yes, we're overbought. Yes, we have a potentially negative seasonal time. Yes, we're getting really extreme with some of our indicators, but we're just not seeing any confirmation based on price yet when we look at our charts. So if anything, we're still going with the up scenario. We are concerned about the sideways scenario because we're so extreme with our ADX charts. The warning signs, growth is not really participating. It was looking a little bit better after Monday. Now it's back to not looking so good again. And the transports, and I should have put an S right there. They're negatively diverging from the Dow, at least for right now. That's a new addition. I've been mentioning it, but this time I wanted to put it on a slide. The equity put call ratio for right now is going back up, and that could be some hedging ahead of the holidays. And we're still having longer term downtrends with the Russell, small caps, and mid caps. But the positive signs, and this is a pretty long list, our daily special K chart is positive. The longer term equity put call ratio is still going down. The risk on posture is showing some improvement, and that is rather encouraging. On a momentum basis, we are still positive. The parabolic SAR and the vortex are positive. The bullish percent index, it's still positive, but it is now getting extreme. The Copic curve generated a recent buy signal. The Zohorchak method hasn't changed yet, but it's back to neutral after having been negative. And small and mid cap growth, small caps are pretty much at the low end of their range, where the mid caps are at the higher end of their range, but not really breaking out yet, pretty much chopping sideways. The financial sector is really showing some improvement, and our longer term new high, new low steady is continuing to go up, and that is positive. So our conclusion, we're still overbought, even though we're positive. We have been breaking out above that range that we were in. We have to wonder at some point, are we going to really shoot higher and create some kind of a blow off top? It hasn't happened yet, and it may not end up even happening. We just want to be aware of that. In the short term, we are very extreme overbought right now. In the intermediate term, we're extreme overbought. We're getting more extreme overbought in the long term, but we remain positive in all the different time frames. So thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.